Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the show. We have a huge episode to get stuck into today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are going to cover a lot. We're going to cover the news and in particular what's happening in reporting season. We're also going to get you annoyed about the big banks. We're going to answer a listener question about active management and the cheapest ways to access that. But let's start with the news because there's a lot happening.
News and markets.
All right, well, the news starts with the RBA. So minutes from the Reserve Bank of Australia's August meeting have been released, and no surprises that the bank considered raising the interest rate, or Australia's cash rate, from 4.35% up to 4.6%.
I think a little surprise. I
Really?
think so many people were like, the next move is down. And I think this kind of solidified that the next move might still be up. If inflation is persistent.
People were saying the next move is going to be down based off a 0.1% change in CPI.
Yes.
Like,
But they were
come
saying
on.
it. They were saying
It's
it.
still 4%.
Yeah. So look, but that was, all like the economists that get
The month
surveyed and
before,
stuff.
they were saying it's going
I
to
know.
go up.
I know. I'm not arguing the logic. I'm just saying
well,
the result.
Yeah.
So the RBA has sent a clear signal that Michelle Bullock in a speech at the time said it's going to be at least 6 months before we cut. These minutes show that they actually considered raising rates. So just everyone needs to temper their expectations.
Yes.
The only people that are not tempering their expectations, it seems, are the big banks.
Yeah. So the big banks, as reported by the AFR, so we've got Commonwealth, ANZ and NAB, they've all cut their rates for their term deposits on expectations that interest rates will be cut at some point.
Well, look,
In efforts to maintain their margins.
Their narrative, it's an effort to get ahead of the RBA. The RBA is about to cut, so we're going to cut our rates that we pay to term deposit holders ahead of the RBA. But the subtext really is they're protecting their margin.
Cut the mortgage rates then.
Well,
If that's the theory.
there's also a theory that they're gearing up for a next round of mortgage price wars as
right.
interest rates start getting cut. So it's like they're going to save money over here so they can compete for mortgages over there. But look, the banks, they are getting ahead of the RBA, well ahead of the RBA it seems. But it just had us thinking about term deposits as an investment option. And I've had a look at some of these banks' term deposit rates. You haven't seen them because I want to get your reaction. So ANZ and NAB I've got here. So let's start with ANZ. For 24 months, lock your money away for 24 months. What do you think you should be getting?
Less than what should be.
Yeah.
At least above inflation.
Above inflation?
Yeah.
Above the cash rate, you'd think. Cash rate plus something?
Maybe at least cash rate.
At least, yeah. But
Yeah.
cash rate is like the risk-free rate.
Yeah.
But now you're locking your money up for 2 years.
Look, to be honest, I wouldn't be. I know those big banks. I wouldn't be expecting a lot from them.
Like economic theory is, look, cash rate is a risk-free rate. If you lock your money away for 2 years and let the bank lend it, you should get, for that illiquidity, you should get some premium.
Yeah.
You don't.
No.
4% a year.
Yeah. Okay.
Yeah. From ANZ. NAB, 24 months, 4% a year as well. Yeah.
Yeah. So you can get 5.5 plus on high interest savings accounts at some of the other banks.
That was going to be the conclusion, which is I don't understand who is using term deposits unless you've got millions and so you go over the savings accounts. Most of these high interest savings accounts have a maximum where they'll pay these bonus interest rates. But that's a separate conversation. For most people in most circumstances, they don't have that money. And when you compare, Macquarie 4.75% or an ING 5.5%, there's actually a heap of banks that now pay above 5% in their high interest savings account. You have to ask what the utility of these term deposits are.
Well, like we have the lease deposit wrapped up in a term deposit. We couldn't have put that in a high interest
For our
savings.
office?
Yeah, for office. So
But
there is utility.
But that's not our choice.
No, I know, but like...
We could go to our landlord and say, hey, rather than putting it in a term deposit and getting 4%, put it in a Macquarie savings account. You don't.
No, you can't have a guarantee. It has to be. It has to be because it's a bank guarantee.
Oh, so it has to
Yeah,
be.
yeah. Anyway, let's keep moving. So reporting season continues to roll on here in Australia, and we've got 3 Aussie companies taking on the world, which we love to see. The first is Breville. So they reported revenue up 3.5% to 1.53 billion. Profit was also up 7.5% to 119 million.
Not crazy numbers. Not what I'd expect you to start with based on those numbers.
What's wrong with those numbers?
What, 3.5% revenue growth?
Yeah, true. But, Ren, the notable figure is that 84% of their earnings are now generated from international markets.
Yes.
Now, this is an incredible story given that in 2019, I think it was, we did a mastermind with Julia Lee. I pitched Breville, and at that point in time, their international sales were sub 20%.
Yeah. This is a true Aussie story taking on the world. These Aussie appliances are now in kitchens around the world. Coffee makers, blenders, toasters, you name it. 84%, yeah. I think they've doubled their revenue in 5 years.
Yeah.
And it's all just been this international
Europe,
growth.
yeah.
Now, you pitched it 5 years ago.
Yeah.
Did you invest in it
No,
5 years ago?
every time I see it as well, I'm like, but there's plenty of stocks I have pitched that I'm glad I didn't.
True.
So, yeah.
Yeah.
Read into that what you will.
So Breville, that's a great story, and we love to see it. Another Aussie company that's taking on the world. This one has a bit more hype about it, but it just had another great quarter, and that's WiseTech. Now, for people who aren't familiar, WiseTech is essentially like a global logistics software. If you're, a big like a DHL or one of the big shipping companies, if you're doing a lot of international trade, managing customs and getting in and out of ports is a nightmare. And WiseTech are essentially trying to aggregate all these small software platforms into their big CargoWise platform and make it easier. And they've just, again, had another incredible set of results. Their shares jumped 18%. Revenue grew 28%, and they forecast another 25 to 30% revenue growth next year. I was reading, so when the shares IPO'd, they IPO'd at about $3.
Yeah.
And it's now over $100.
Wow.
Yeah, it's just an incredible story. They traded a price to earnings of like 100 now, but they're not cheap, but they're just, incredible what they've done. And then Bryce, one more Aussie company taking on the world. Let's talk about Pexa. Now, for people unfamiliar, Pexa is like a property settlement platform. They've taken an offline process, put it online, and they're kind of a monopoly in Australia. And so the story is, can they take on the world? Revenue up 40%, profit up 21%. But the interesting thing is the UK expansion, where they're trying to establish themselves. It's progressing, and international revenue, they hit 36 million, which was ahead of most investment banking estimates. But I also just want to quickly throw this tidbit in. So Jarden, the investment bank, shared a research note about Simply, SYMPLI, which is the ASX's rival property settlement platform that's trying to take on Pexa's monopoly in Australia. Apparently, this is all according to Jarden, the ASX have invested $75 million into it. It's not doing too well. And without further ASX investment, they think it will run out of money by 2025.
Oh, wow.
Yeah. So it seems like the ASX's attempt to disrupt this property settlement monopoly not going too well. The ASX haven't had too much luck with investing in new platforms and settlement systems recently.
No.
All right, Bryce. Well, reporting season, it's full of company results. We're not going to be able to unpack them all in detail. Let's put like a little music here and just do a results wrap, try and bang them out in a minute. As many as we can go. Let's do it.
Nice. Well, Ren, I want to start with Hub24, company we spoke about last week. Funds under administration has soared 35% this financial year. Analysts now expect that EBITDA will grow 64% in 2025, and the companies say that in the next 2 years they're going to grow funds under management of close to 70%.
Wow. Yancoal, the coal miner, cut its dividend, not paying any dividend, signaling it's serious about buying more coal mines. Aussie investors don't love a dividend cut. Shares fell 17%.
Medical glove maker Ansell has cut 10% of its workforce as it works through a post-COVID glut of personal protective equipment.
And finally, the owner of Kathmandu and Rip Curl, KMD brands, reported overall sales were down 11%. Kathmandu in particular, sales were down 15%.
Well, that's the latest from reporting season and big news headlines here in Australia. If you want to keep up to date, remember to sign up to our daily newsletter where we'll provide you with the latest in business and news headlines, as well as questions answered by experts that have come from the community. So sign up. Link will be in the show notes.
Let's ask the community.
Hey, Equity
I
Mate.
just had a question.
All right, well, it's that time. We're going to answer a question from the Equity Mates community. This one comes in from Alex.
Hey, Bryce and Alec. Big fan of the show. I have been hearing a lot more about active funds and managers, so it would be great to hear how Bryce is going with his Fairlight investment, as well as just to learn some good sort of active funds and managers in Australia with a low initial investment for beginners like me to get into it as well. Thanks, guys.
All right, well, Bryce, I think that question is more directed to you than to me, so I'm going to take a back seat on this one.
Well, I mean, you're also invested in Fairlight, but yes, so to start with it'd be great to hear how Bryce is going with Fairlight. So for those that have just joined the show, I've made an investment into a small cap fund manager here in Australia. They are unlisted. They are called Fairlight. We've had them on the show a couple of times. I just really love listening to them and kind of back them in for my small cap exposure because I don't have the time to do the diligence required at that end of the market. And also investing in a small cap index is not the way to go when you want small cap exposure. So I've taken a position with them. Early days though, 4 months in, and I see this as 7-10 year journey with these guys if they continue to perform. But yeah, 4 months in, so I'm not making any sort of calls on whether it's the right decision or if it's been a success, because that's the wrong way to look at it. However, if we do look at their performance, past 3 months, 7.3%, and then the past month, 7.1%, just above their benchmark. And I do intend to put a second round of investment in when I hit the 6 month mark.
Okay.
Yeah.
Why the 6 month mark?
Oh, that's just because when I anticipate I'll have a bit ready to chuck in.
Yeah.
Yeah. And I don't want to just have one lump sum. I want to keep building the position over time.
Yeah.
Not as regularly as I do with our core portfolio, but yeah, just something that I'll probably tip in twice a year or something.
Yeah,
something
nice.
like that.
Nice. Now, the second part of the question was all about active managers with lowish initial investments for new investors. Now, there's probably like 3 approaches that you can take here, and there's one approach that we think is the best, but just to signal what they are. The first one is you look for unlisted fund managers and you see what their minimums are to invest off platform, just like directly with them.
Yeah.
The second is if you have access through an advisor to a platform like Hub24 or NetWealth, all those minimums go away.
Yeah.
Must be nice. The third way, and this is the way that we can approach it as everyday investors the most easily, is you can look at which fund managers have active ETFs, because there's more and more of those coming to market. We've had a look at some that we'll talk through in a second, but just my overall takeaway was, wow, there's a lot here now.
There are a lot. Unfortunately, when you look at what's listed on the platforms that the advisors have access to, it's like daylight.
Oh yeah, I mean, like there's
Daylight.
there's like 10,000
Yeah,
funds
I
that they
know,
can access.
It's like, damn it.
But to be honest, I don't need 10,000 funds.
No, but yeah, it is it's still alarming the opportunity that those with advisors get.
It's one of our biggest frustrations, and it's not the conversation for now. The opportunity gap in Australian finance between the advised and the unadvised.
Yeah.
The 10% of Australians that have an advisor, just the buffet of options that they get access to. Well, the scraps of us.
Yeah. So anyway, we've had a look at some of the funds that are listed that are good performers historically, because that's, to your point, Ren, you don't want to be looking and making a decision based on minimums. You actually want to be looking at, are these fund managers performing? Have they been doing it over a long period of time?
Yeah.
And
well,
so,
I mean, because they're ASX listed ETFs, you're not making the decision on minimums.
Yeah,
so you
yeah.
can just focus on
performance.
everything you're saying.
Yes. So we've had a look at non-index tracking, non-sector tracking, and non-specialist strategies. What we mean here is just broad-based. Like, these guys are going out and buying a portfolio of global companies. They're not doing like infrastructure specific, or whatever it may be.
Or like bonds or income,
yeah.
or they're not trying to do like a particular tilt.
Yes,
Yeah,
yeah,
it's
they're
just
just-
like, we're just trying to get returns
Yeah.
by investing in companies.
Yeah. So this is based on 3-year returns. The best performing is the Munro Global Growth Fund. The ASX ticker is MAET. They've been doing 13.69% per annum. Second is Loftus Peak Global Disruptor Fund. The ticker is LPGD. They've been doing 13.5%. And then Antipodes Global Shares, 8.4%. The ticker is AGX1. So those are the top 3.
Love that. Love that 2 of the 3 have been on the podcast.
Yeah.
That's a ringing endorsement, I think. They're the best performing over the past 3 years. I think it's important to stress that you shouldn't just chase past performance. Seth Klarman, in his book Margin of Safety, talked about the institutional performance derby, where people just chase last year's performance or the last 3 years' performance. So it's like, it's one thing to look at those numbers and say, okay, well, they've done well recently, so hopefully they keep doing well. But it's also like, what's the underlying strategy? Can you read some stuff from the manager, or can you listen to them on a podcast? What are their top holdings? Do you think what they're saying aligns with the companies they're investing in, and stuff like that? A few other companies that I think you could go and research depending on what you want to invest in. If you're just looking for just straight, which obviously didn't do too well in 2022 and 2023, I think Hyperion Global Growth is one to look at. Aussie Shares Airlie's Australian Share Fund always is sort of highly rated and seems to have a really good reputation in market. That's co-managed by Emma Fisher, who's a favourite here. The guys at Firetrail, Anthony Doyle's been on a few times. They've got an active ETF. I actually haven't looked at its performance, but they seem pretty switched on. We recently spoke to the JP Morgan team about the active ETFs that they have listed over in Europe and America that they're bringing to Australia, their income series. JEPI is the world's largest active ETF that they're now listing in Australia. So that could be another one if you're more interested in income.
Yes.
So a few names to go and research, but God, there's so many out there.
There are a lot, yeah.
We've got a list of all ASX listed ETFs. We'll include that in the show notes, and you can research to your heart's content, knowing that all of them have low minimums because they're ASX listed.
Yes. Check the fees. So
yeah. Well, the good thing is that this list includes their fees. Some of the fees are still none of the ones that we listed, but some of them on that list, fees are still above 2%, which feels like not where the world is at the moment.
Thank you for the question, Alex. If you want to submit a question, head to equitymates.com/contact and leave us a voice message, and we'll make sure we answer it.
Equity Mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.